Okay, so for those who don't know, I am Katie Garner. I am a Rocktree Realtor at RE/MAX Advantage, and today I have with me Todd Jenkins with the Atlantic Bay Mortgage Group.
Hey guys, how are you today?
I think everyone's doing pretty good, hopefully. I know these are some crazy times. I know we're getting together today because there's a lot of craziness going on in the market. I know people are experiencing a lot of anxiety as to what's going on. So hopefully today Todd and I can clear up some of that stress for everybody. Todd, can you share a little bit about your team and what you do?
Yes, I manage, along with my wife Tiffany Jenkins, the Central Virginia Atlantic Bay Mortgage Branch. Atlantic Bay Mortgage Group is a 900-person company based in Virginia Beach. Been in business for 23 years, and all 900 employees help people finance homes. So that's what we're here to do.
Awesome. Thank you for that. So I know we're not here to talk about just coronavirus, more about the market, but I thought we'd touch base on it just a little bit. So from what we know so far about coronavirus is that it's actually a family of viruses. The interesting part about this is that it seems to spread not the traditional way from person to person or animal to animal, but actually from animals to humans. We know that the most recent discovered virus is the COVID-19, and that's the one that made the news and all the mess in Wuhan, China. We know that it causes symptoms similar to the common cold or the flu, with the body aches, congestion, runny nose. About 80% of our people who are infected with it, they're recovering, thank God, and only 1 out of 6 people actually become seriously ill. The problem is that it affects the older people and those who are susceptible a lot more than all the young people. So the young people may be asymptomatic, not experiencing any symptoms at all, and going to the store, running around, doing their daily activities is actually causing problems for our other dynamics there. So hopefully everyone is staying inside and staying healthy during these times. So then jumping right into it, I feel like some of the questions that we've been receiving the most is, are we entering another recession? What is this going to be like? You know, I think when people think about recession, the very first thing they think of is 2008, because that was obviously one of the worst ones that we've had in recent years. And then how I know this market is actually more comparable to the one in 9/11 rather than 2008. So we'll go over that a little bit. And then of course what the projections are for 2020 here. Okay, so I guess, what is a recession and are we in one now? Todd, did you have anything that you wanted to say about that?
Yeah, so I mean, I think there's definitely some economic downturn that is, looks like we're pushing towards that. I don't know that I've seen that it's been labeled a recession, but you know, we're definitely in a downturn on the numbers on Wall Street. Some things of importance, though, in the mortgage lending world, I started in the industry in 2005. In 2007, early 2007, products that the mortgage industry was offering was, you know, there were hundreds and hundreds of hybrid products and no doc loans and options that, you know, you could just pull credit, get an appraisal, and sometimes not even have to do that in order to get a mortgage loan. And so the good thing this time around is we do not have that in the mortgage industry, on a very low amount of non-prime loans that are available. Somebody's got, sorry.
Let's see if I can mute everybody. There we go.
Okay, got it. So that's the most important thing that is different from 2008 is our housing market, our housing industry and mortgage industry is in a much, much stronger spot, and also not as in my opinion, as an exposed spot as far as loans that people can't actually pay. There's going to be hurdles. There's going to be forbearances coming up on for potential job loss. That's going to happen. But the industry as a whole is much stronger, and that should protect our values, in my opinion, going forward.
Right, right. And so the next question, I notice people are nervous to buy or sell houses at this point. To offer a little bit of peace of mind there, just in the past week in our area, covering Charlottesville, Waynesboro, just Augusta and Albemarle counties, we've actually sold 142 homes. 176 homes have come under contract, and we've had 204 new listings. Now, those are obviously some really good numbers considering the times. Todd, can you tell us a little bit of what the interest rates are like right now?
Yeah, so the volatility of the economic times as a whole, with the stock market and the bond market, has put a lot of pressure up and down on interest rates. So it has been definitely somewhat of a wild ride from day to day, from hour to hour, interest rates over the past 4 weeks. It has put a bit of stress on our part of the housing industry, with rates changing drastically, sometimes day to day. We have gotten this week a little calm. It's been fairly consistent throughout this week after the Federal Reserve stepped in and bought some securities, or bought some mortgage-backed securities on last Friday, Monday. It has calmed some this week to be able to offer similar rates for most of the week. Interest rates are not as low as the bottom several weeks ago, but they're right now fighting in the mid threes on a 30-year fixed, and so those are things you just need to talk to your loan officer about, and and work with them to get to a payment that you're comfortable with.
Mm-hmm. Do you think right now is a good time for our buyers to lock in those interest rates, or what do you think is going to happen there?
Yeah, so we are actually not at all-time lows as we were about 3 weeks ago. We were down, the industry was down closer to 3%. But in the history of interest rates, where we are right now, other than that blip a couple of weeks ago, we are still at the bottom of where I've ever seen interest rates. So what that tells me is, if I were buying a house today, or if I was refinancing, I would lock in an interest rate, and roll and be protect my high side. So if they are close to the bottom, I think there's more room for them to go up.
Right. I think you're right there. I know I've noticed a lot of our millennial buyers are kind of nervous just because the interest rates are reaching up a little bit. But I know in 2008 we had some really crazy interest rates, upwards of 6%, if I'm not mistaken. So
yeah,
we are.
In 2006, 7, 8, in most of during the housing boom of 2005, 6, 7, the mortgage rates were around 6%, sometimes up to 7, sometimes down to the mid 5s. So the interest rates are in a much better place currently than they were the last time we had an economic downturn.
Right. And so what is the probability of obtaining a loan in these times?
Yeah, absolutely. We're still lending money. We are, there is, the standard loans, the FHA, the VA, the conventional financing through Fannie Mae, Freddie Mac are still absolutely strong, and we're moving forward with lending money. You're going to potentially see some pullback from lenders and things I've seen on some of the fringe products, meaning jumbo financing is going to become a bit harder, and you know, you're going to see some, you know, some things that are going to get a little tighter just with any recession. But the absolute positive to take from this is the loans that we could do in 2008, FHA, VA, conventional, USDA, Virginia Housing, VHDA, are all in play now. And we don't have hundreds of other products in the industry like we did in 2007 during the last downturn. So you should not see a whole lot of change as far as the ability to get approved.
Right. I thought we'd jump in a little bit. I don't know if I showed you these slides, Todd. I wanted to jump in a little bit into the 2008 crash because again, that is what everyone is comparing our current situation to, and it strikes a lot of fear in people. So I know there's a lot of factors that go into play here, but I know one of the very first ones is the mortgage availability. I mean, we aren't giving out loans like candy anymore. It's a little harder to obtain a loan now. I know that plays a major role in how this is different from 2008. You can see that large housing bubble there compared to today, where there's definitely a major difference there.
Absolutely. That's a great graph there. That should spur confidence in where we are today and how much stronger we are than we were going into the last downturn.
Right. You hear a lot of people getting nervous right now about being in a housing bubble, but it's really no comparison to then. And then we jump into home housing appreciation. Obviously, homes are still appreciating, which is good. If I'm not mistaken, I believe it's a 3.6% is considered a healthy appreciation, and we're slightly above that, but we're not in that crazy rates that we were back in 2008 either. We're still, as you can see, in pretty healthy growth there.
Absolutely.
Let's see here, and then inventory. So right now, I know we are in a shortage compared to a surplus. I know that was important because we need about 6 months of inventory to sustain a healthy and balanced market. Anything over that 6 months or so is considered a surplus and can cause price depreciation in housing. And so we're just sitting at that 3.1 mark right there, which is pretty healthy as well. And then another factor that caused the 2008 crash there was just the prices versus the wages. Houses are more affordable now in the sense that we have higher wages, lower interest rates. I know at that time the prices of the home and the mortgage rates were out of this world, and then people just weren't making enough money, so people can afford their mortgages now. Even in the chance of a recession, it's not going to be the same effects. And then back in 2008, it seemed like everyone was using their home equity as more of an ATM, right? People aren't doing that now. As you can see, the refinance is dramatically different here, but also, oh, sorry, go ahead, Todd.
Yeah, and I can just share, in being in the industry during both lead-ups, in 2005 to 2007, probably 50% of my phone calls that I received as a loan officer were people trying to cash out their house. In the past 4 years, as we have stabilized and started this trend upwards, I would say personally less than 3% of my business has been cash out refis.
Okay.
I feel good about that. I don't have a lot of clients that are asking about that, and trying to use their house, like you said, as an ATM. So I think we've been responsible. I think the industry and the mortgage industry has curtailed that. Interest rates are slightly higher on a cash out refi than a purchase or just a rate and term. The guidelines on how high of a loan to value you can go to haven't gone up. So for instance, you could go to 95% on a cash out refi on FHA back in the 2005 to 2008 range. And I remember doing that loan a number of times for clients. And in this time, it only maxed out at 85%. So the industry as a whole has done a great job, in my opinion, of holding back that ATM.
Right. We've kind of learned from our mistakes there. I think we even saw where 50% of homeowners right now have over 50% of equity in their home. So there's really no comparison there. And then back to appreciation. So obviously in 2008, we experienced some major depreciation, but out of the past 5 recessions, we've actually appreciated in 3 of them, which as you can see, and also the 9/11 crash there, we appreciated. And that's the one that our market seems to be reflecting more than any other, simply because during that time, during that panic, everyone stayed home and they were afraid. So we saw a decline in entertainment and tourism, all those service industries, much like we are now. So we'll actually jump into that. That's kind of what we're doing with all this social distancing, where everyone is staying home, and as a result, some businesses are shutting down, which is actually a good thing in this case because we don't want people getting more sick. And then we do have the volatile stock market, as we talked about a little bit earlier. It seems like things are all over the place a little bit. So then there's the .com, the Y2K, and the 9/11 crash here. We actually saw during 9/11 houses appreciate nearly 24% during that time. Todd, do you think that's what we're going to be seeing here as well, another appreciation during this time?
In my opinion, I think as we come through this, we get out on the other side, you could see a boom potentially, not only on the stock market, but on the housing market as well. So, we're always going to need a place to live. Every one of us is going to, that is looking to buy a house, can buy a house, is going to buy one, no matter, hopefully everything is much better in 3 to 6 months. But I think once we get to that all clear, you're going to see people coming out of the woodwork to buy homes and to move forward with their life. And during this downturn, the industry as a whole, I've just been amazed by all the collaboration, even between mortgage lenders. I mean, we always compete against each other, but I'm having conversations daily with other mortgage lenders. And what are you doing? How are you doing this? How are you making it? How are you helping people buy homes? And, in our real estate professionals, realtors, attorneys, title companies, appraisers, everybody is just really rolling and trying to figure out how we make it through this as an industry. How do we protect our home values? How do we help people continue to buy homes? And it's just amazing, the collaboration and, and the technology advances over the past couple of weeks. And, we're going to make it through. And if you see that as we are, which we are, and right now might be the best time in your lifetime to buy a home. Mm-hmm. It could be, because I think as we come out the other side, all in a much better position, you're going to see appreciation. I don't know how much, but I think you'll see appreciation not only of the stock market and appreciation of the homes, but that inventory level is going to go down. So, buying it during this time when interest rates are super low, could possibly prove to be the best time in the current times to be able to buy.
Right. Absolutely. And that we kind of covered this a little bit just then, as far as the market projections, but kind of like you were saying, right now we're just walking into the second quarter, and as you can see on the Goldman Sachs graph here, we're gonna dip just a little bit more. And I think this is all dependent on when we can beat this virus, as far as when the growth will begin again. But um, from what we're hearing, after the peak of the virus, we should shoot right up again, because people get antsy staying in their homes, and they want to get back to their daily lives and go shopping and travel and do whatever people do on their daily lives. And walking into that third quarter there, it's also walking into the holiday season as well. So um, just like you were saying, I think we really have good things ahead of us. We just need to get over this hump here. Um, so I guess the bottom line at this point is, the most important thing is just to not panic and to stay home, stay healthy. We are experiencing a slowdown in the stock market right now, but the housing market is still steady and strong. People are still buying homes. They're still selling homes. Um, we don't honestly know what the future holds, but I think based on the information we've seen today, I think we have a positive outlook here. Um, I know that I also made a guide for y'all to download and take a look at a little bit. It has my information and Todd's information in there if you have any questions. It covers everything that we talked about today. Um, all these slides and all this information was provided by Keeping Current Matters. They're really on top of it, as I'm sure you follow them as well, Todd.
Yes, yes, absolutely.
Right. They're really great. You can check them out at keepingcurrentmatters.com. Todd, can you tell us a little bit how you're operating business during these times, in case people are ready to buy the house?
Absolutely. So we're open for business. We lead a team of 6, and we are all working daily. We are technology-wise able to work and also be secure. The security that we have behind our information is hugely key, and we take that extremely seriously. So we have technology where clients can securely upload their information, from their home computer straight to our underwriting system that has a huge firewall. So we have all that technology in place. We can do e-signatures on applications. We are we're here to talk through the process, talk through the process of obtaining a mortgage loan. We are working remotely, taking it very seriously, what's going on, the health of not only our group, but more importantly, the health of all of us. And as a company, I think we are somewhere around, I don't want to misspeak on the numbers, but I think we are, the 900 employees, about 800 of them are currently working remotely and not missing a beat. We are doing daily conference calls with our management team, all face-to-face on the computer, just like we're doing now. Our team gets together a couple of days a week on calls as well. And so we are rocking and rolling and have not missed a beat, and are only potentially even stronger, in our communication ability to help now. And we look forward to serving anybody that needs our help.
Right. Thank you for that, Todd. And us realtors as well. I mean, we're able to do virtual showings now, buyer and seller consultations via Skype or Instagram or FaceTime. I think it's been amazing to see the creativity and ingenuity people have been putting in to still manage their businesses. But Todd, thank you again so much for joining me today, and hopefully